Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and we're discussing the portfolio mistakes to avoid with Alekh Yadav of Sanctum Wealth. One of the mistakes to avoid, obviously, is being too skewed towards any one particular asset class and not have a well-balanced portfolio. Now, something that can perhaps help us stay away from this is the category of funds known as hybrids, where you have a mix and match of various asset classes, and all of them are offered by the mutual fund world. In fact, if you look at the returns of some of the hybrids, returns have been looking pretty decent in the last couple of years, though, of course, we must remember that past returns are not an indication of future performance. But nonetheless, I mean, look at that table. It's pretty self-explanatory. Double-digit returns coming in. And many of these funds, by the way, are fairly tax-efficient as well. They have better than FD taxation. And that's why, Alekh, I wanted to, draw you in.
Yeah.
Which of these categories makes sense to you?
Sure. So for a conservative investor, two categories to look at. One is equity plus equity arbitrage, which is basically investing in stocks which are, you buy some in cash, you sell some in futures. Overall, you're hedged. You get debt-like returns and debt-like risk, but they are taxed as equity mutual funds, so you get a much healthier post-tax.
So that's the arbitrage category.
That's the arbitrage.
And that's been getting a fair amount of funds last
Exactly.
2-3 months. In fact, I've noticed this. The arbitrage category has been drawing in almost 15,000 crores from investors over the last two odd months or so.
Yeah.
So arbitrage is a category, something that you like.
That's right.
And what else?
Yeah, so that is the most safest one. Then slightly, if you can take a little more risk, then there is a category called equity savings, where the fund will take about, say, 30% odd exposure to equities. The balance, 30-35% would be in arbitrage, and the rest would be in debt. That could be for somebody who can take a little bit of risk, has slightly a longer time horizon, say 1 year plus. You get slightly higher returns, as you can see here.
8%.
Yeah. And the taxation is again equity taxation, so that also helps in this case.
Now, this category of dynamic asset allocation, or the balanced advantage funds as they're called, this and the multi-asset allocation category, this has been getting a lot of flows. In fact, we'll just pull up the bars as well. I think we have the data as well. Over the last couple of months, systematically, there's a lot of money that's flowing into the balanced advantage fund category, as well as multi-asset funds. So yeah, arbitrage is what we were speaking of. So even, like I said, last 2 months on arbitrage, the flows have really picked up. Look at other categories like balanced advantage, very steady sort of, number of, funds coming in. And multi-asset, look at that, about 3,000 crores, more than 3,000 crores in some months coming in this category as well. So they're clearly gaining in popularity.
Yeah.
Do they make sense to you?
Yeah. So especially for people who don't have access to advisors or wealth managers, for them, I think this is a beautiful category. What multi-asset and balanced advantage fund do is they move between equity and debt if it's a balanced advantage fund, depending on the fund manager's view on the market. In a multi-asset, the movement would be between equity, debt, gold and silver as one category. And that allows you to get exposure to all the three categories. They're tax efficient because most of them are taxed as equity mutual fund. And if like in current markets where you're uncertain, then the fund manager takes the call of deciding which asset class to be.
Okay, so arbitrage, multi-asset, balanced advantage and equity savings. A couple of categories that perhaps one can consider. Within that, the choice of funds. Give us some names, some ideas, some AMCs that you like.
So I think in the arbitrage, the clear sort of preference that we have is for Kotak Equity Arbitrage Fund. That's the most consistent arbitrage funds that is out there. It generally does like 10-15 basis point higher, like 0.1, 0.2% higher than other arbitrage funds. The model, the technology that they've built in allows them to get a slightly higher premium than the rest of the funds. So that is the preference there. In the equity savings category, there is a fund by ICICI Pro Equity Savings Fund. They are a little more conservative fund manager. What they look to do is they look to buy only 20% equity, and that also mostly large cap. And the rest is arbitrage, and then there is a little bit of debt. They're more conservative compared to the other ones, and they've been fairly consistent. So you may not get the upside, but at least the downside is protected with ICICI Pro Equity Savings.
Okay, so that's the equity savings category.
Equity savings.
More conservative approach.
Yes.
What else do you like?
Yeah, so in the balanced advantage category, the dynamic asset allocation category, the HDFC Balanced Advantage Fund is something that one can look at. It's a little more aggressive. What they look to do is they also take a little bit of mid-cap and small-cap exposure in their equity. The equity portion is managed very similar to the HDFC FlexiCap focused strategy, which is a little more value-oriented. And the debt is simple, plain vanilla debt. So I think that's one category that one can look at. A little more aggressive, but fairly consistent.
And what would be a fair return expectation from, let's say, an HDFC Balanced Advantage fund?
Yeah, so the fair return expectation there should be about, say, 11-12%, so
which is not bad.
Which is not bad, so you get maybe 1-2% lower than equity over a longer period of time. In the last 5 years, it's done 20% plus because markets have done well. But yeah, generally, I think that should be the expectation.
And what about multi-asset? Because they have to, by definition, invest at least 10% in every asset class, right?
Yeah.
So do you like anything here, or would you rather do it separately? I mean,
so for HNI investors that have access to advisory services, for them, it makes sense to do it separately. But for retail investors who don't have access to that, I think it makes sense to do multi-asset funds. There are, you could look at, say, like an ICICI multi-asset fund. They have very good, the model which selects funds between, equity and debt is pro, and they've been following it for a very long time. They have a lot of,
and it's an old fund, it's not a new fund.
It's an old fund. It's one of the largest funds also in the category. So that's a fund that one can look at. And that's also done well in the last 5 years, 20% plus. But I think the expectation there again should be around, like, say, 10-11%.
Which is not bad. So, that makes me think and brings me to the close of this conversation. If some of these hybrid funds with lesser volatility can give you 10-11%, then isn't there a very strong case to have a greater part of your portfolio going into hybrids?
Yeah. Exactly. For retail investors who cannot do the asset allocation themselves, this is a powerful fund. You get the equity taxation, the movement of the asset allocations done by the fund manager. I think it makes a lot of sense. For HNI investors, where they can do other stuff, like in the deck, they can do not only debt mutual funds, but other funds. I think for them, there are other options that are available. For retail, it makes sense.
All right. So final word then, half the year is done, Alekh. What's your advice for the second half of the year? How to make money?
So I think, just remaining invested is the most premium thing here. I think there are going to be some alpha generation possibility that mutual funds can have. So selecting the right mutual fund, being with people who have proven themselves in the past, I think will also help. This may be a time for active mutual funds than passive mutual funds.
Okay, all right. So keep your eye on the ball and eye on the stocks that perhaps can outperform. Got it. A very, very helpful conversation. Thank you very much for joining us on the show today. Thank you.
Thank you so much for having me.
All right. Well, folks, hopefully you found that interesting and engaging. I certainly did. Keep sending us your feedback, comments, and queries. As always, we'll see you with another conversation. Same time, same place next week.
Let's talk money